There's a lot of equations when it comes into retirement because everybody's path is different, right? And everybody's state is different. So what I mean by that is you guys may talk to 55-year-olds that want to retire. They've been successful and they want an earlier retirement than some. That 55-year-old married couple, when they go on the marketplace and their income and the state that they live in, the tax credits that you qualify are different than the 65-year-old that's going on to Medicare and the 60-year-old that's going into the marketplace, and their income could be exactly the same and they live in a different state.
Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome back to Metcalf Money Moment, the podcast. My name is Jeb Graham. I'm here with Ethan Hutchison and Eric Wymore, who are co-hosts of Metcalf Money Moment, the podcast. We've got a couple special guests today. We have Matt Sturgeon, who is the CEO of LNI Insurance Solutions, and we have Phil Walters, who is the director of Medicare for LNI Insurance Solutions. And we're getting ready to do another podcast after this that's going to talk about how to retire early. And I know one of the biggest things that we always get from clients is, or I guess the big elephant in the room is always health insurance, right? It's, there's the how much money do you need for retirement and all those types of things. But then there's always kind of that crutch of health insurance and how, number one, how expensive it is in their minds. And number two, just how complicated it is to kind of understand exactly, how much money you can make and keep your insurance premiums at a certain level. So, and by the way, Matt's done our company health insurance benefits for a number of years. We share a number of clients with them because we've sent them there. They do a great job. But Matt, can we kind of just start talking about if we have a client that's going to retire early, I guess, what are the things they need to know about health insurance and where do they start? Thanks
for having us, Jeb. We get this question all the time. We work with financial advisors all across the Midwest, even across the country. And a lot of early retirees or retirees in general ask the same question. They have in their head, I got to work to the age of 65 because I have to keep my health insurance, because they really don't know what's out there in the individual market. There's tons of ways that they can turn, whether that's on the marketplace, off the marketplace. We even compare against their COBRA options that they have offered at work at times. It all depends on the makeup of their household and their income. A lot of people don't realize that, a married couple in their 60s that are making over $100,000 a year still qualify for tax credits on the marketplace to lower that cost of insurance for them. So, and what are the ages of those individuals? You mentioned we have Phil on the call. Is one 65? Is one 60? Is one going into Medicare? There's all kinds of different avenues that we can turn with individuals that are looking to retire early. So when you're looking at, and you actually mentioned that scenario of someone that's retiring at 60 and their spouse might be 65. So they're going to go ahead and jump on Medicare. I mean, are there certain strategies or first of all, I would assume that the first thing they need to do is call someone like you guys, right? To kind of, and you guys are running them through a process of here's your age, here's your income, here's how much health insurance is going to be. But that particular client that's 65, that has a spouse that's 60, where are we starting there? Phil, I'll let you take this one.
So what we do is we bring the client in and we take a very deep look into exactly their wishes and their wants. So if, when myself and my team meet with somebody that is 65, we talk about their options and just take a deep dive and keep it very, very simple. And if they do choose to make that transition into Medicare, then we look at, other options. We always look at COBRA, because if their spouse is currently going through a medical event, and if they have medical bills and they hit their deductibles, it just makes sense to stay on COBRA. And then, that's That's one avenue. If they're don't have any medical issues or just go to the doctor once a year, we'll look at short-term medical for their spouse. We'll look at the ACA coverage. We can look at off-market plans. We look at we customize. We give them a customized plan to fit their budget and their needs and their wants to fill that gap between the time that they need to make that transition into Medicare.
And Jeb, the question gets asked, like you posed, how much money can I make? When that paycheck stops and they go into retirement and they're living off retirement income, as you guys know, they can control that income. So you guys can walk them through, what's their budget? Do they still have a mortgage? What vacations do they want to take in retirement? Do they want to add the deck on the back of the house? Take all that into consideration of what they want to do with their retirement money. But then when they want to do that, how much do they qualify for in tax credits or subsidies? And then that opens up a conversation where someone like myself, a health insurance advisor, and for those that are under 65 years old, they then they have the opportunity to work with you guys and budget that income, to fit, okay, that fits inside my budget for health insurance, the deck, the vacations, they can fluctuate all of that around.
Hey, Matt, when you talk about income, what types of income count towards that number? Is it, sweat income, W-2 income? Is it dividends and interest, IRA distributions, and so on? Can you share us a little bit with what counts towards income?
So it's anything that counts towards modified adjusted gross income. And UC Berkeley actually did a chart out there that shows all the calculations that go to modified adjusted gross income. So when you look at your tax statement, there's a line that says adjusted gross income. I think don't hold me to this, I'm not a tax pro, but I think it's line 11 on a 1040. So to answer your question, I would ask a CPA, what inside my retirement is going towards my modified adjusted gross income. Don't listen to the health insurance guy. But just know it goes anything under adjusted gross income.
I was going to ask, and kind of dovetailing off of the initial comment from Jeb, we're focusing on early retirement. Let's say we've got a client we're working with, and they're 45 years old. Their goal is to retire at age 50 or 55. How early should they be contacting someone like you to really dive into what that would look like? Is 5 years before retirement too soon? Should it be 12 months before they plan on retiring? What's like a time frame when they should be checking that box?
So for someone that's under the age of 65, you want to have a smooth transition into retirement. So I think it's safe 6 months or so for, to give the opportunity for them to have the conversation with their CPA, with their financial advisor, with their health insurance agent, so they can really zone in on what is retirement going to look like and have that pre-planned before they take that leap or turn in their 2 weeks or whatever it is they want to do. And I know Phil can speak on the Medicare side. There are income thresholds in Medicare, like around IRMA and things that individuals need to know that, say, one of the spouses are 65. So Phil, you want to give them some insight on IRMA?
Yeah. So when we partner with our financial planners, we educate them, and we hold seminars. I travel everywhere from Tulsa to Maryland, and do webinars all over the country. And when we partner with our financial planners, we target age 63, the year that they turn 63. The reason why is because when a person makes that transition into Medicare, they turn 65. Well, a lot of people don't realize that Medicare is going to look back 2 years. So give you an example. This year, if a person comes into Medicare in 2025, Medicare is going to look back on the second year. So in 2023, they're looking at their total AGI. If they are single and if they make less than $106,000, their standard Part B premium is going to be $185 per month. If they were married, filing jointly, that benchmark is $212,000. So anything over those benchmarks, they have a tiered chart, and depending on where they fall in that chart, they're Part B of Medicare, and they're going to be assessed in IRMA. And IRMA is an acronym, and it stands for Income Related Monthly Adjustment Amount, and every year it gets reassessed. So, and that goes on for life. So when we talk to our financial planners, we just give them those targeted, rates. So, a person doesn't get overwhelmed when we're talking about Medicare. They're saying, hey, your Medicare Part B is only going to be $185 a month. But they don't know on the backside that they're bringing in income over, $1 million a year. And really their Medicare Part B is basically going to be assessed, over $400 a month. And that's per person. So that's a big shocker when it comes into retiring and planning for that income. And just to be aware of that. So when we meet with our people, with the financial planners, we encourage 2 years before they retire. That is the target year.
That's a super great point. And I think that what you're doing is making a point for us, as far as like when we're meeting with our clients, because a lot of times that's never the very first part of our conversation with them, right? Usually we're talking about their financial plan and all this stuff. And there's always going to be a couple little surprises that come up in somebody's retirement. A lot of times that's what it is. And I'll tell you, so that Medicare stuff is super, super important for somebody that's retiring early or that's going to be retiring later. I'll tell you the other thing with people that are retiring earlier, and I don't want to necessarily get in the weeds, Matt, but I was actually working with a lady just the other day who's getting ready to retire, and she started running some numbers. Luckily, over the years, we've built up, she has a ton of IRA money, but she also has a really good, what we call non-retirement account, where we can get money out that she doesn't have to pay taxes on, right? So we can keep her in a super, super low income tax bracket here for these first few years of retirement. But she went in and she was running the numbers, and basically I think her Mendoza line was like $30,000 a year. If she made under $30,000 a year, she was basically getting next to free health insurance. It was very, very cheap. And if she made over that amount, it went up very, very significantly. And I know you and I were talking yesterday, and there's an equation for that. And it's not the same for each person, right? So I don't know if there's any, and I don't want to get deep in the weeds, but maybe we can kind of high level hit on that a little bit.
So yeah, absolutely. There's a lot of equations when it comes into retirement, because everybody's path is different, right? And everybody's state is different. So what I mean by that is, you guys may talk to 55-year-olds that want to retire. They've been successful, and they want an earlier retirement than some. That 55-year-old married couple, when they go on the marketplace and their income and the state that they live in, the tax credits that you qualify are different than the 65-year-old that's going on to Medicare and the 60-year-old that's going into the marketplace, and their income could be exactly the same and they live in a different state. But there are factors inside states which, like the Medicaid line. So in the state of Kentucky, just south of us, we're in Indiana, their Medicaid line is 100% of the FPL, federal poverty level. In the state of Indiana, we have a thing called HIP 2.0. So you don't start qualifying for tax credits until you're at 138% of the FPL. And things like that adjust the second silver level plan on the marketplace, which adjusts the tax credits in your location. So individuals, let's go back to the 55-year-olds in Missouri. They may have the same income as the 55-year-olds in the state of Indiana, but based upon the second level, the base reference plan, silver level plan on the marketplace, their tax credits and the plan options are going to be different. So they're not going to be paying the same amount or qualify for the same amount of tax credits. It's truly a case by case thing.
So our key there is we need to tell clients basically that they've got to see somebody like you guys, because that's certainly above our level of expertise as far as health insurance. And I think partnering with companies like yours are huge for us. So
yeah, that's a huge, really good point, Matt, because I run across this a lot where we're speaking with a client and they say, oh, well, my neighbor, they're on Medicare and they're only paying, $185 a month. That's what I'm going to budget for. Where their scenario is completely different. They could have double the amount of income, and they're not, that neighbor, right, that they're talking to is not sharing that with them. So it's not going to be apples to apples when you go door to door.
Right.
That's right.
I was going to say there's some individuals that just, they've been really successful in life and they don't qualify for tax credits at all. And they are healthy individuals, knock on wood. They've never had any health issues. One thing about the marketplace versus off marketplace that Phil and I keep talking about, when you go to healthcare.gov, there's a thing called guaranteed insurability. All the 10 essential health benefits are covered, right? So if you have that health condition or stage 4 cancer or whatever, that's the place you want to go because that's going to be covered day one of the plan. Same with Phil and Medicare. That's covered day one of the plan. But if you're the healthy 60-year-old that's never gone to the doctor, you've never had health issues, and your income is above 400% of the federal poverty level in retirement, and you don't get tax credits, some of those situations, those price tags can be pretty hefty, and they can go off the marketplace into other options, into, some private plans or share plans, or there are many other options that are off the marketplace for those type of individuals as well.
Speaking of options, once you walk into a Medicare plan, say at age 65, is that what you are on for the rest of your time on Medicare? Or are you able to switch plans or switch, coverages each year? Or how does that work?
When they make that transition into Medicare, they are in the Medicare world for the rest of their life. So within the Medicare world, you have different options. You could stick with original Medicare being your primary, and then you could purchase a Medicare supplement and a drug plan. That's option one. Then when you're looking at option two, that is the world of what they call Medicare Advantage plans. Those are privately held companies that have plans that are out there on the market. They're different from company to company. And then we take a look at everything. They can take a look at everything every year and adjust to what fits our needs.
Well, very good, guys. This has been super insightful. So real quick, for our client base and people that are listening, how do people get a hold of you guys?
Well, like I said, we are located in Indiana, but we do work all across the country. I think, Phil, we're in 32 states total now? Might be more. But they can call our office anytime, 812-490-0200. They can find us on Facebook or the social media under LNI Insurance Solutions, or they can go to our website, li.insure.
Well, very good. Well, guys, thank you so much for coming on today. Again, it's Matt Sturgeon, who's CEO of LNI Insurance, and Phil Waters, who is the Director of Medicare. And this has been a super productive, few minutes. And this is Metcalf Money Moment, the podcast, signing off.
Thanks, Jeff.
Thanks, guys.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.